And we welcome back for the third of 5 consecutive appearances all week long here on the agenda, talking about rethinking economics. There's Paul Summerville, Senior Fellow at the Centre for Global Studies at the University of Victoria, former Chief Economist for RBC Capital, and most shockingly, a Bay Street economist who once ran for the NDP in this very riding.
Well,
I'm still trying to figure that one out, Paul.
Well, you know, I always like to say that a lot of times it's not where you end up, it's where you came from.
I get you.
And a lot of the people I studied with at Glendon College, Norman Penner, James Laxer, you know, who led the waffle movement, were my professors. And I think I benefited a lot from instruments of social justice around education and the science of good health that I think many investment bankers, many more than you think, actually on Bay Street, think are really important for the long-term health of the economy.
Well, we're going to talk, as long as you mentioned it, investment versus speculation here,
right.
What the difference is between those two things. Because, of course, we've just come out of the G8 and the G20. We are trying to rethink economics right now. We have seen what's happened with the subprime mortgage and the housing crisis in the United States and how that's almost, you know, made the whole house of cards around the world tumble down. But let's start by really going back to basics here. Let's understand the distinction between someone who is an investor and someone who is a speculator. What's the difference? Well,
the difference is the risk, pretty simply. For example, if I'm an investor, I suppose, if I put my money in a Canada savings bond. I'm an investor if I buy some RBC Dominion shares. I'm probably an investor if I buy a home here in Toronto, unless home prices have been going up, you know, for the last decade at, say, an 8% annual rate, and then interest rates are still really low. So the amount of return that I can get as a consequence of that investment shifts it from something that's an investment to something that's speculative. So, for example, I see people making extraordinary speculative investments every day when I'm in the drugstore, when they buy Lotto 949.
Now, that's not an investment, that's speculation, you
Pure
said.
speculation. The ratio, the chance to win the big jackpot is 1 in 13 million. That's speculation.
That's pretty high risk.
So
high risk, high reward, though.
So that's your definition of being a speculator. Are you prepared to bear the risk of losing all your money? Certainly, whenever you buy a Lotto 949 ticket, you are, particularly if your intention is to get the biggest prize. So you need to put a value or an expected return on what it is that you're doing.
Okay, let's take it out of real estate for a second. We'll come back to that. But you're a former Bay Street guy, so there are terms that you guys use that I think most people, you know, it's a different language.
Sure.
You know, shorting, commodities futures trading, and this kind of thing. Talk to us about that and how that is different from, you know, investing versus speculating.
You take a unit of money and you're trying to increase its value. I mean, that's really what investing is. And the more technologies develop, communication technologies, information technologies, financial technologies, you touched just a second ago on a couple of them, the more opportunities there are to take that $1 of value and try to increase its value. So if I go to you and say, well, if you give me you know, $1,000, I promise at the end of the year to give you $2,000. On the scheme of things, that may not seem, you know, very speculative, $1,000 or $2,000. It's very speculative because I'm doubling your money. In fact, if I said to you, if you give me $1,000, I'm going to give you $8. Or $100, I'm going to give you $8. That's 8% return. That is an extraordinarily high return. So,
extraordinarily high relative to inflation?
Relative to inflation, relative more to the history of returns.
Okay.
So when you want to think about returns, you want to put it into some kind of historical context. So ex-inflation, it again gets a bit more complicated. Let's just take what they call the nominal return on your investment. So the things you just referred to, the jargon on Bay Street, just refers to a different way to invest in the marketplace.
Well, let me try to understand how constructive it is, because let's talk shorting. People short certain stocks. I mean, you're essentially betting on failure. You're betting on things to go worse. How is it constructive to the economy to make money betting on things to be worse?
Well, let's step back for 1 second, because you don't necessarily make money. You might lose money. You know, you may short you know, the housing market. You may short a bank stock, thinking that its company's badly run, that the earnings aren't going to be what people are going to say they are. that there's going to be some kind of economic event that is unpredictable that's going to hurt that stock, and you short it, and you're wrong, and you end up losing money. I think very strongly that shorting is a very powerful way of disciplining companies for lying about what they're doing.
Because Congress wants to, well, they talked about outlawing it because they think it's, you know, you're betting against America.
But I think that's because they misunderstand what a short is really doing.
So it has a constructive role to play.
It disciplines the market. It disciplines players in the market.
How does it do that?
It prevents them from lying about what they're doing. It makes them more disciplined in terms of the way that they're running their business, the kinds of people that they hire, the people that they do business with. So these financial technologies, they get a lot of headline attention.
A lot of bad publicity.
Well, of course you get bad publicity because you only hear about them when something is really breaking down, like a country like Greece is on the verge of default. But shorting Greece is a good thing because it puts the spotlight on the Greece government to say, go collect your taxes, don't offer such lucrative present-day entitlements when you can't afford them. And same thing to a company. You have to run your business better. You have to get rid of your president because he's doing all the wrong things and you're in the wrong business lines. So it's a way of disciplining the market. And it's just the reverse. You could just simply turn it around and say, well, why don't you just outlaw people buying stocks and equities, going long? It's just the balance of that.
Let me try this. Earlier in the week, you know, I used a baseball analogy to help me out here because that's something I do understand better than finance. And I'll do the same thing here. There was a time, once upon a time, maybe 100 years ago, when the average Major League Baseball player made 6 times the average industrial wage. And now it's 800. Okay? It's really different. You can probably say the same for Wall Street. Once upon a time, you know, Wall Street earners were not earning what they are today relative to what the average industrial wage is. Is there a disconnect between how much they make on Wall Street and, you know, Mr. and Mrs. Everyday America?
Well, I always think it's what the market bears. And if it really bothers you, then tax it away. So it's not a function of what people make that really matters. It's a function of whether you, as a community, make a decision that over a certain number, $1 million, $5 million, $20 million, that you were just lucky to be there at that point in time, and then it belongs to the community. I would probably make the case when it comes to resource development that I would rather tax away that, because I see that more as a community, something that's owned by the society, rather than maybe an investment banker that's developed some very powerful technology that didn't actually necessarily have bad consequences, had all the good intended consequences. Someone who develops a Blackberry, for example. Shouldn't they be able to enjoy the fruits of their labor? Or someone on Wall Street who figures out a way and creates a financial technology that benefits people.
But here's the difference. You know, everybody understands you invent something as neat as the Blackberry, you deserve to get rich. But if you've figured out some kind of tricky financial instrument that really doesn't, you know, it makes people on Wall Street prosperous, but it really doesn't do anything for North America.
Well, give me an example.
Well, I'm afraid you're going to say that, and I don't know if I can do it. But you know, no, you know what? I can't give you an example.
So let's step back and.
But I think I'm happy that the guy who invented the Blackberry and made my life better. Not everybody would agree with that, but I would agree with that. I'm happy he gets rich. Some guy who comes up with some new technique on Bay Street that enriches them but nobody else. I think people may have a problem with that.
Well, they may have a problem with it, and it's probably because it's not evident to them the way that technology actually helps financial markets become more efficient, helps a bank or an investment bank provide a service to their clients.
Okay, that's what I need to know then. There actually is something constructive about some of these, very esoteric things that are invented.
Take a currency future, for example. So basically, you're an exporter, and you earn a lot of your earnings in U.S. dollars. And what you're afraid of is that U.S. dollar is going to decline in value against the Canadian dollar because you have all your expenses in Canadian dollars. So really what you're trying to do is manage the risk between a cost, which is in Canadian dollars, against a revenue, which is in U.S. dollars. And someone 15, 20 years ago, whenever it was, said, well, hold on a second. Let's design a financial instrument that helps that person manage that risk so they can go ahead and they can buy U.S. dollars at today's value so they don't have a shock, a year from now when the Canadian dollar jumps up in price. Now, the fact then that that helped companies run their business more efficiently doesn't, I think, invalidate that other people said, well, hold on a second, maybe we can use that to make bets against the US dollar or the Canadian dollar or against the euro. I think the more efficient and the more transparent these products are, the people that know how to use them, the people who invent them, are entitled to the money that they reap from them.
As long as you tax them high.
That's a different conversation.
Okay.
That's a different conversation.
I promised a few minutes ago we were going to end up on real estate, so with our last few minutes here, let's do that. And you've mentioned Neil Ferguson, and you like him and his book.
Very much so, yes.
So he was in that chair not too long ago. Let's play a clip of what he had to say, and then we'll come back and talk. Michael, roll tape.
There is actually a problem with home ownership. You're encouraging everybody to take one big leveraged play on one market, the real estate market, take on a lot of debt to do that, and have most of their wealth held in that form. But houses are not like stocks. They're quite hard to unload in a crisis. They're illiquid assets.
Let's start with whether or not you agree with him that people's primary investment in home ownership is a strategy that is too focused on one thing.
Well, I don't agree with Neil in terms of how he framed that. I see where he's headed, because obviously he's talking about in the context of a housing market that failed. But really what's more important was the incentives that people had to go into that housing market. And I think that's much more important than the asset that we're talking about.
Understood.
So we're talking about buying a house and living in a house. But if you create, say in the case of the United States, mortgage deductibility, which encourages people to continually to move up in the housing market.
I don't know if everybody knows what that is, but basically you can write off on your income taxes your mortgage. Is that right?
That's
right. You
right.
can deduct it from your income taxes that you have to pay.
So when I lived in the United States, I always thought that I lived in the most socialist country in the world. Right? When I came from Canada, people said, you're socialist up there. I said, well, hold on a second. You know, you've got an American military which spends more money than the next 14 countries combined, that provides great health care and great education benefits and great pension benefits to people who pass through it. But your socialism is really the housing market, of which mortgage deductibility is the prime example. So there are lots of incentives to go into the housing market that create a more speculative environment.
Well, they would say they want to encourage an ownership society.
Well, the point is that you're saying that. I'm saying it gets divorced from the ability to actually own that house.
Got it.
And the simplest measure, the reason Mike Barry and these other people who wanted to short the housing market cottoned on to what was happening, is they just looked at a very simple number, and that was the percentage of Americans that own their home. It trended around 55% up until around 2003, 2004. And then it trended up towards 60. And it was that simple 5% change in the number of people that own homes in the United States, which set the background for the collapse in the housing market. Because not only did people buy homes that they couldn't afford, but the conditions that created that then let people lever their homes into higher levels of lifestyle than they might otherwise.
You had politicians in Congress telling Fannie and Freddie, get out there and meet your quotas for giving people homes that they probably were not entitled to have.
So a lot of the, the context then of analyzing what happened in the U.S. housing market and the problems have a lot to do with Wall Street, but there's also a political, cultural, and social context within which that happened. And so the real estate market can become very speculative, but it has usually more to do with the kinds of incentives that have nothing to do with the real estate market that are set up around it.
Do you think, again, getting back to the first question, do you think real estate ought to be more of an investment or more of a speculative venture?
Well, I think that it ought to be purely investment, and that the Bank of Canada and Mark Carney is very good in talking about this kind of stuff. Flaherty's been very good at signaling this kind of thing. When you start to talk about 40-year mortgages, when you start to talk about mortgages where you only put 1% down, that is now creating the conditions for a speculative housing market that's really dangerous for the common person.
But I think we got into some situations here in Canada, and I stand to be corrected on this. Did CMHC, Canada Mortgage and Housing, not come out with an option which allowed you only to put 5% down to buy a house?
For a short period of time. And unfortunately, that's a small bomb that's ticking in the Canadian economy.
I was going to say, you'd be opposed to that, I presume. Eh?
Absolutely. I think we've got to be very clear about what home ownership is. It is a very important step in a person's life, but you've got to be very disciplined about the way that you enter into it. And consumer protection agency that we have in Canada that prevented a lot of the abuses that occurred in the United States is a very important part of that, and something you've talked about on your show, which is financial literacy.
Right.
And because a house is such an important part, not just of a person's investments, it's part of their life. It's where they want to raise their children. It's where the neighborhood that they live in. It should have nothing to do with speculation.
In our last minute here then, I think everybody who owns a home likes the notion of their home increasing in value, you know, nicely every year. That would be a good thing. Double-digit increases to the point where you're creating a bubble that will eventually pop. Obviously, everybody wants to avoid that. Is it possible to avoid the bubble?
Of course it is.
How do you do it?
Well, you do it by not creating artificial incentives to own a home that have to do with mortgages where you don't have to put anything down, mortgages where interest rates are perhaps artificially low for a period of time. But I think most importantly, financial literacy, educating kids, particularly children, but young adults, about the risks of buying a home when you don't really have the money to pay for it.
In the schools, you want to see that?
Absolutely. I think we should start with compound interest at the age of 5. And it'd be really easy to do. You could say to every student, okay, in grade 1, we're going to pretend you have a bank account with $100 in it, and we're going to compound it at 5%. And when you graduate, hopefully in grade 12, how much money will you have? I think that would do more to prevent people from getting on the other side of the trade, which is to have them paying debt compounding over that period of time.
A nation of savers.
That's
not a bad thing.
That is a great thing.
Yeah. Okay, Paul, thanks so much, and we'll see you again tomorrow.
Thank you.